Well, good afternoon, everybody. My name is Lee Schwartz, and I'd like to welcome you to our webinar for dental practices. Today's topic is Year-End Tax Planning 2021, what's new and what you need to plan for. Now, I noticed a lot of familiar names on the attendee list. I know a lot of you have been a part of our past dental webinars, and we're excited to continue bringing you this important information. So we will jump in here in just a couple seconds, but a couple of quick housekeeping items. If you have a question during the webinar, open up the chat box in Zoom and submit your question to all panelists. We're going to try to leave a couple minutes at the end for Q&A, but there's a lot of ground to cover today, so we will see how it goes. Also, we are recording this webinar today. You'll receive an email with a link to a survey, as well as our SVA resource page where the webinar recording will be available. Now, many of you are already clients of SVA, and we'd encourage you to reach out to your SVA contact if you have questions coming out of this. I'd also encourage you clients to share our contact details with other business contacts who could use our help. Over the last year and a half, we have found that there are just a ton of practices out there that aren't getting timely or knowledgeable advice from their CPAs or their advisors. And obviously, we'd love that introduction. We'd love to help. Now, if you're not a client and you have questions, please reach out to me and I will get you connected to a subject matter expert at SVA who can help. Also, I want to give a quick shout out for our recently completed dental salary and benefits survey. If you participated in this survey and shared your data, which about 100 practices around Wisconsin did, you should have already received the results to it. If you didn't participate and would like to learn more, again, please get in touch with me and we can talk about how to do that. A lot of practices are using this data to remain competitive in this very difficult hiring and retention climate. Okay, so with 2021 coming to a close, it is the perfect time to review your practice's tax planning strategy and look ahead to 2022. Our presenters today will go over the latest legislations that may affect you, the business and personal tax planning strategy scenarios, and next steps. So if you've attended any of our past webinars, you're already familiar with Matt Vanderloo, who's a principal in our healthcare practice and also SVA CEO. But this may be the first time you're meeting James Emmerich, who's a senior manager in our healthcare and dental practice. Both Matt and James help lead the team that works with dentists around Wisconsin and really the whole Midwest to help them minimize taxes and maximize profitability. So I'll be back towards the end to wrap up and hopefully for a little bit of Q&A, but for now, I'm going to hand it over to Matt.
Thanks, Lee. Really excited to have some time with all of you this morning and for carving some time out of your schedules for us. I think some really great information that we're going to get to cover today. I'm excited to not have to do it all myself and to let James do some of the heavy lifting with me here today. So at a high level, what we want to cover today, and actually before we get to that, I forget, we wanted to do a quick poll to get things started this morning. Going to ask everybody a quick question. Have you already discussed some proactive tax planning with your advisor for 2021? If you want to go ahead and give us an answer there, we'd love to see where people are, see what you've done so far this year. Give everybody a minute to respond. So it looks like everybody participating today is in really good shape. More than 2/3 of you have already talked about tax planning here for 2021. A few people that haven't talked about it yet, haven't thought about it yet, a couple people that have it scheduled and on the docket. So lots of people in really good shape there. So we're going to go through some things today that you're going to want to make sure you bring up during that discussion with your advisor if you haven't had it already, or hopefully topics you already covered with them if you already had your meeting. What we want to cover today, talk a little bit about the latest tax legislation, what's going on in Washington, D.C. right now, what we think we might see happen, what we can expect there. A quick update on PPP loan forgiveness, the employee retention tax credit, some business tax planning ideas, some individual tax planning ideas, and then a little wrap up at the end. We'll give you some next steps, some things to get started on and think about. So first, thinking about what's happening in DC, a little bit of a legislative update here. We did a presentation much like this on some tax topics about a year ago at the very beginning of December last year. At that point in time, we had just wrapped up a presidential election. We were waiting on some runoff races in Georgia to see how the Senate was going to shake out. But if you'd asked me last year to look ahead 12 months, I probably would have said with all the COVID related stimulus that's gone on, with all the dollars that the government's pumped into the economy, by this point, 2021, I think we're going to see some new tax laws with lots of tax rate increases to help pay for all of it. And I think as we stand right now, we haven't seen anything get signed or anything happen yet. We had a couple big gubernatorial elections at the very beginning of November that I think may have changed the Democrats' outlook on things and may have pushed back and pulled back a little bit on what they want to try and accomplish and what they think they can accomplish. And that's had somewhat of a drag on their proposed tax wish list and everything that I think they originally wanted to have in some new tax legislation. So we do have a proposal out there that we'll talk about here in a second, but it's changed a lot from what we first saw back in September. The first draft of the tax bill that came out in September had across the board tax rate increases, whether you were talking about individual taxes, both ordinary income and capital gain, corporate taxes, gift taxes, estate taxes. If you could think of the tax, there was a way they were going to try and increase it and make some changes that were, especially for higher income taxpayers, going to see some pretty significant increase in taxes. But things have changed since then, and they've really scaled back on that bill. And things continue to change. It's still a very fluid situation. Things are changing constantly. I think where we are right now, we've got a bill that doesn't have a ton of increases in it. It's set right now for a House vote, hopefully this Friday. So we might have some more information this Friday. But the Democrats have such a tenuous lead or advantage in the Senate right now, and that any one senator, any one congressperson holds pretty significant sway. So there's still a lot of negotiating and things going on behind the scenes. There are some changes, maybe even a lot of changes that are going to come from this tax bill that aren't going to affect the people on this call. A lot of the changes, especially the increases, are really focused on what I'm going to call the tip-top earners in the economy, people who are making in excess of $5 million, $10 million a year and some income on them. We don't see any dental practice, dentist tax returns at our office that exceed that kind of income on a regular recurring basis. So I don't think we're going to see a ton of our clients impacted there. And I think it's going to be a relatively limited impact in terms of the number of individuals. So more specifically, the bill that's out there is called Buildback. It's the Buildback Better plan. There have been a number of different iterations of this plan, but the most recent one was from October 28th. This is the one that hopefully we're going to see a House vote on this Friday. A couple of big changes that I think are going to impact most of the people on this call and that you'll have to consider. The first one, kind of a negative here, I think we're going to see an expansion of the 3.8% net investment income tax. And we're going to see that expand to include any active business income. So most of the dental practices we work with are structured as S corporations right now. So the owner of the dental practice probably takes some income out as a W-2 regular paycheck from the business, the practice. And then there's also a significant amount of profit that probably comes out through that S corp return. It gets reported on a K-1. The owner reports that K-1 income on their individual tax return and pays ordinary income tax on that, and we're done. I think we're going to see that expanded so that that income that's coming out of the S corporation is not only subject to ordinary income tax rates, but is also going to be subject to this 3.8% net investment income tax. It's 3.8%. It's not a new tax. It's been around for several years here. It was originally part of the Affordable Care Act, but previously is really only applied to investment income. So typically interest, dividends, capital gains, things like that. But looking to expand that and make this S corp income subject to that tax as well. So one potentially negative change, and that tax would start to kick in for single taxpayers if you're at $400,000 of taxable income. For people who are married filing jointly, $500,000 of income. So a little bit of a negative there. The one positive I think we see in this bill is that we're going to see an increase in the state and local income tax deduction. A couple of years ago, that deduction, along with an increase in the standard deduction, that increase for that SALT deduction was limited to $10,000 per tax return. The plan right now has an increase in that from $10,000 up to $80,000. So a pretty significant increase in how much we can deduct there, which would open up the possibility to lots more people being able to use their itemized deductions again. Wisconsin's a relatively high tax state, so usually we have plenty of real estate taxes, state income taxes we can deduct, and usually we're limited to that $10,000 amount. With this increase, I think we'll get to see a lot more of those taxes become deductible again, and potentially a lot of people who took the standard deduction the last few years getting back to being able to itemize their deductions. I think the other really big news out of this plan is the places where we're not seeing changes, where there were a lot of proposed changes, but now they're all off the table again. Top individual tax rates, we're not going to see an increase there. Capital gains rates, we're not going to see an increase in capital gains rates. There were some plans to eliminate the opportunity for people to do what's called a backdoor Roth IRA contribution. That restriction has been pulled out, so those will still be an option for people going forward. And there were going to be some limitations on the qualified business income deduction, but those restrictions have been pulled back. So there were lots of potentially negative changes out there, all that have been pulled back. There are going to be lots of other little detail things and some increases in this Build Back Better plan, but most of them, again, I don't think are going to apply to most people on this call. There's some expansion of the child tax credit. Most dentists returns we work on, their income tends to be high enough that they lose a lot of that child tax credit anyway, so I don't think you'll see a benefit there. There's also going to be some expansion of the earned income tax credit. It's not going to apply for anyone on this call either. So lots of big things going on there. More details to come as things get voted on and finalized, and we'll be out in front of you with those details once we have them. But that's where things stand right now. With that, I want to kick things over to James for a few minutes to talk a little bit more about PPP loan forgiveness and some employee tax retention credit topics.
Thanks, Matt. And thanks everybody for joining us today. So this slide here really is going to serve more so as a reminder that we're talking about PPP. And so the most important thing to take away from this slide, if you take away from anything from this slide today, is that once your loan is forgiven, remember that gets moved from the balance sheet as a liability over to the income statement. Once it's moved to the income statement, that income is not taxable. Okay, so if you take anything from this slide today, please, please, please take away that the PPP loan, once it's forgiven, is not taxable. Okay, the expenses used for the PPP loan, those are deductible. So really this loan has turned out to be the best of both worlds. The income you receive is not taxable. The expenses that you used, the money for, the wages, those are deductible. So it's really been a beneficial item for practices. Okay. The last bullet point here, it says most practices should have a significant portion of their PPP loan forgiven with only payroll costs. Some of you may have used interest or rent, but predominantly most of the loans that we've seen, you've been able to get the entire loan forgiven just by using wages. Okay. So now you might be thinking, okay, well, what's next? So I got my loan forgiven, and on my balance sheet, I have a bunch of cash. How are we going to get the cash out of the practice, or what can we do with the cash? Okay, well, there's a couple different options that you have. Maybe you have some high interest rate debt sitting on the books. Maybe we want to look to use that cash to pay that debt down. Another opportunity lies that maybe you want to reinvest into your practice, right? Maybe there's a piece of equipment sitting out there that you've been meaning to purchase or that you'd like to get your hands on. You have this excess cash, we can look at buying that piece of equipment. And then the other option is maybe you want to take the cash out for yourself, okay? Well, you can see on the screen, there's 4 different entities, and each of these entities has its own unique tax structure. So it's important here that you work with your tax advisor to find out the most advantageous way for you to get that money out of the practice and to you, because the last thing we want to do is have a surprise at year end. So please make sure you're working with your advisor on how to get the money out of the entity. Looking ahead, the employee retention tax credit. This is available to practices if you meet one of 2 criteria. And the first criteria is you had to be fully or partially closed or suspended due to a governmental shutdown. Most of the practices that we've seen here in Wisconsin do not necessarily meet this criteria and qualify. So we've moved to the second criteria, which is a revenue or receipts test. So when you look at your receipts, you break down your year by quarter and you look at your 2020 quarterly revenue and you compare it to the 2019 corresponding quarter and see if you have a 50% or greater drop in revenue. Okay. So again, you look at 2020 receipts, break them down by quarter, and then you're going to compare it to the same quarter in 2019. And if you have a 50% drop or greater, then you are eligible for the employee retention tax credit for 2020. For 2021, it's the same methodology. You're going to look at your revenue by quarter. You're going to compare it to 2019 again, but this time instead of a 50% drop, it would be a 20% drop. So if you incurred a 20% drop in revenue in any quarter in 2021, when you compare it to 2019, you're again eligible for the employee retention tax credit. Okay. One thing that really you need to consider though, is if you've already applied for PPP loan forgiveness or you're working on your PPP loan forgiveness, is you have to consider the employee retention credit in conjunction with the PPP loan. Okay. So there's no double dipping of wages. So if you've taken your wages and you've applied for PPP loan forgiveness, well, all the wages that you use for loan forgiveness, you cannot use for the employee retention credit. That would be double dipping of wages, and the IRS certainly doesn't like that. Okay. So next, we're going to move into the business tax planning. But before we do that, we're going to do a quick poll. For tax year 2021, do you think you will pay more taxes, less taxes, or about the same? Give everybody a few seconds here to chime in. All right. Just as I suspected, the majority of the individuals on this call think you're going to pay more in taxes. Nobody thinks you're going to pay less taxes. And about a third think about the same in taxes. So thank you everybody for participating. So the business tax planning section, okay? The intent here is to really give you some ideas or strategies that you can use to start to reduce taxable income in your practice, okay? One of the first things you can do is review the retirement plan design. Let's look at maximizing the contributions for the owners. This is a great opportunity to put money away for retirement while also reducing the profit or the potentially taxable income in your practice. Another option is to reimburse owners for professional business expenses that you're currently paying personally, right? So let's make sure we have an accountable plan set up. Let's get you reimbursed for your dues, licenses, subscription, cell phone, any business related expenses that you're paying personally. Let's make sure we're reimbursing the owners for those, okay? Another business tax planning opportunity is to utilize accelerated depreciation. You can see we have section 179 and bonus depreciation listed. Those are different avenues and different items that are available to us that we can utilize to really write off the entire cost of the piece of equipment. Okay, so you can buy a new piece of equipment, place it in service, and we have the ability to deduct all of it, or at least a good majority of it. Okay. And you can see the little bullet point underneath. It says, consider equipment needs for early 2022. So if there's a piece of equipment out there that you've been thinking about and you know you're going to place it in service or you're going to buy it in early 2022, this could be an opportunity for you to place it in service. Go buy it now. Let's try to get it into the practice before the end of 2021 to allow us to take some accelerated depreciation and reduce the income for this year. Okay. Restock on supplies. So as we get close to year end, you want to restock your supplies and get that deduction in the current year. If you have inventory on your balance sheet, be cautious there because inventory is not deductible. It's an asset until later when you use the inventory. Consider a high deductible health plan. So if you have a high deductible plan, let's look at maximizing your HSA, right? You can put up to $7,200 into your HSA. This money is going to grow tax-free and it stays with you. It's not one of those you use it or lose it types plans. It's not one of those. And then manage year-end taxable income to utilize section 199 or the qualified business income deduction. Dental practices fall under the specified service trade or business rules. So what does that mean for you? Well, that means that there's phase outs and there's limitations on what you can deduct. So if you're a married filing jointly filer, once your AGI hits $330,000, you start to run into the phase out. And if your AGI exceeds $430,000, you've completely phased out and you would be not eligible for qualified business income deduction. Okay. Looking ahead, the next thing we can consider is electing S corporation status. So here as a S corp, you can take tax-free distributions out of the practice. It's a return of capital. So you're taking some of the profit and wages. Some of it comes back to you as a tax-free distribution. Well, the money that you're taking out as a tax-free distribution as opposed to wages is where you're going to start to see some savings on the payroll taxes. Okay. Let's consider employing your spouse and your children in your practice. You can put your spouse on payroll, make sure they're contributing, working through the practice, and then we can maximize their retirement contribution. Children can earn up to $12,000 without having to file a tax return. So here's an opportunity for your child to get into the practice, do some work, make some money, and then they have earned income, so they're eligible to contribute to a Roth IRA. It's a great way for them to start earning and saving money at a younger age. And then another way that you can kind of reduce profit in your practice is to consider what we can do for our employees. Right now, we know employee retention is a huge challenge. Everybody's looking for employees. Maybe consider some year-end bonuses, some perks that can keep employee morale and satisfaction high. And it's a deductible expense for the practice. And the next point here talks about the different expense items that we have available. So let's separate out 100% deductible travel. Any travel related to the practice, as long as it's not commuting, is deductible 100%. We have a 100% deductible meals category. And what's going to fall into this category would be your Christmas or holiday parties, full office gatherings. Those meals are 100% deductible. Okay. Then there's the standard 50% deductible meals, and then there's non-deductible entertainment. So we'd like to see on your income statement a line item that says entertainment. Make sure you're grouping anything in there that is entertainment related. And remember, that's not deductible. Okay. One item I do want to mention is that for 2021 and for 2022, any orders, meals orders from restaurants are going to be 100% deductible for 2021 and 2022. The reason being is Congress really wanted to stimulate the restaurant industry. So they're hoping that by allowing these meals to be 100% deductible, more people will start going back, ordering meals, getting takeout from restaurants, and you get to deduct it 100% instead of the standard 50%. Okay. The Wisconsin entity level deduction. This is an annual election that is made. And what happens here is at the entity level, you elect to pay state income taxes for the practice to the state of Wisconsin. Okay. Those taxes that you pay to Wisconsin are then deductible on the federal tax return, and that's where the savings start to occur. When you reduce federal taxable income, the savings there generally outweigh the taxes that you paid to the state of Wisconsin. And then the last bullet point on this slide talks about deferring income and accelerating expenses at year end. So we're getting close to year end. You get some invoices that trickle in and they're not due until January. Okay, well, let's consider paying those now in December before we get to January, because the expenses that you pay are going to be deductible in the year that you paid them. So it's an opportunity for you to reduce income in the practice. And with that, I'm going to turn it over to Matt so he can talk about the individual tax planning portion.
So some important opportunities and things to think about here on the individual side. If we do see an increase in the limit for the state and local real estate taxes deduction, we could see lots more people who have the opportunity to itemize deductions again. So this is going to mean taking a look at your charitable contributions again and how we want to do those to maximize you into the best tax situation we can. Donating appreciated stock to charities is always a great idea. You get the best of both worlds. You get the contribution at the high level and you don't have to pay any tax on the long-term capital gain. So a great thing to consider. If you still aren't sure if you're going to be able to itemize or not, consider using a donor advised fund. These are available through most of the major brokerage houses. Can allow you to group multiple years worth of contributions into 1 year to force yourself into that itemized deduction spot. If you or your spouse has outside income, let's think about setting up a retirement plan for that income to generate some more tax savings. The backdoor Roth is back on the table. It doesn't look like that's going to be eliminated in this new tax bill. So if you have the cash flow, if you have the ability, let's do a backdoor Roth, contribute to that non-deductible IRA and convert it right away to the Roth. A great strategy to put away some dollars from retirement and to get some tax-free growth on those dollars in the Roth IRA. If you're looking at saving for educational expenses for kids or dependents or other people in your lives, let's look at using the EdVest plan, or you're not a Wisconsin resident, whatever the state 529 plan is for your state, as a way to save for those educational expenses. And we can get really creative with how we fund those. We don't have to just fund them for the person who might be going to school. We can fund them for multiple people and then kind of consolidate those later on as they start to need the dollars. And remember that those EdVest dollars can be used not only for college type costs, higher education costs, but they can also be used for private school tuition in a limited dollar amount every year. So if you're paying private school tuition, we can really work hard to try and coordinate what you're paying for out of EdVest, what you're paying for personally, so that you can also use the Wisconsin private school tuition deduction. So there's a couple different opportunities there that interplay that you really have to think about carefully and really make sure you're coordinating to maximize your deductions. If eligible, the child tax credit's going up for this year. The dependent care credit is taking a pretty big jump this year. If your income's low enough, that dependent care credit this year could be up to a $16,000 credit. It's a pretty significant increase from where it was before. It's not going to apply to a ton of people on this call based on income limitations, but that might be something worth looking at and considering to see if you can get yourself down to a level where you qualify for it. And depending on your income, maybe looking at a Roth conversion is a great idea. Fill up some of those low tax brackets with some taxable dollars. One other thought here, not really tax related, but if you haven't looked at your interest rates recently, if you haven't refinanced recently, now might be the time to do that really quick. We're seeing some hints at some inflation, and if we have any kind of long-term consistent inflation, we're going to see the Fed start to raise interest rates to try and combat that, which would lead to increasing rates on personal debt, business debt, line of credit, things like that. So refinancing right now at what are still historically great rates, if you haven't done it recently, is going to be a great idea. So next steps, what can we take away from here? If you haven't already, make sure you're talking to your advisor about tax planning before the end of the year. Looks like most of you have already taken care of it and have done some planning, but you might want to revisit that with them with some of these topics in mind. If you don't have a retirement plan, or even if you do, take a look at that retirement plan, reevaluate it, review it, make sure it's doing what you want to do in the practice. With employee retention being such an issue in so many practices, this is a great way to make sure you're up to date and on pace with what the market's doing. Think about when you want to take that depreciation expense. If there's new equipment you need in the next 6 months, do we want to do it in 2021 or do we want to do it in 2022? Make sure all those business expenses you're paying are paid for by the business. Don't pay them personally. Make the business pay for them, get them paid on a pre-tax basis. And if you've got the cash flow and the ability, take advantage of that backdoor loan. And then last but not least, this is a really important one, that qualified business income deduction is still out there. For a married couple, you get the full advantage of that up to about $330,000 of income. And then it phases out between $330,000 and $427,000 of income. You can use things like the retirement plan, depreciation deductions, personal expenses paid by the business to try and help manage your income, to manage yourself hopefully into an income range where you can qualify for that deduction. If your income's big enough, you won't probably be able to get it down low enough to qualify. But if you're right on the edge of one of those break points, being smart about your depreciation deductions, those other deductions can get you to a point where you qualify and you take advantage of that qualified business income deduction. Flew through a lot of stuff there in 28 minutes. One last poll quick before we wrap things up. Based on the presentation, based on everything we've told you, more tax planning needed, or do you think you're in good shape for 2021? Give everybody a second to respond here. Looks like most of you still think you're in really good shape and have thought of most of these ideas, but about a third of the people out there, no, I'm reading the poll wrong. Only about a third of you think you're still in good shape, and hopefully we've given everybody lots of good ideas then. About 2/3 of you think a little more planning might be needed here for 2021. It's only the 18th of November, so there's still some time to get together with your team, think about that, think about all the options that are out there, and really plan for 2021.
All right, Matt. Wow. Holy smokes, that's a lot of information in now 29 minutes. James, also, you guys, great stuff. A lot to think about. And we did have a couple questions come in. I'm going to throw one or two at you real quick. One was about 401k plans. Do I have time to set up a 401k plan still in 2021?
Setting up the 2021 401k plan, I think your ship's probably sailed there. It's a little too late to do it for 2021. But right now is the time to get it done and think about it if you want to do it for 2022. You're going to want to jump on that right away so you can have it in place and operating for all of 2022, if that's something you want to consider.
Now, what about, and this wasn't asked, but I'm sure people are wondering, for those that already have a 401k plan in place, is there still time to reevaluate what you have and make changes?
There'll still be some time to make some tweaks to the plan for 2021. So you'll still have some opportunity, but I think this is also the great time to take a look at it to get any bigger changes you want to make to the plan in place for 2022. Some of that you can't do this year just because some of it requires notification to the employees about what provisions you're changing and how that's going to impact them. So you might be able to make the change now, but not have it effective until 2022.
Okay, thank you. So a few more questions had come in that were a little bit more specific about business expenses and what's personal and what's a business expense, but maybe we can reach out to those folks individually because those were very specific questions. And we want to be respectful of everybody's time. So as we wrap up, I just want to let everybody know that SVA has created a resource page, which is svaaccountants.com/dental, where the recording of this webinar will be located, as well as e-guides and past webinars, other resources, including that dental salary and benefit survey I mentioned earlier. Our next dental webinar will be on December 10th, and the topic will be provider relief funding reporting requirements. That is going to be a big one. I'd like to remind you all on the webinar that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, please contact me, Lee Schwartz, and I can get you in touch with a subject matter expert here or help you get the answers to any questions that you may have. So thank you again for joining us today. Have a great rest of your day, and we hope to see you at our next webinar on December 10th. Bye-bye.